Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to the third instalment of our podcast mini-series, which outlines our key investment views going into 2024. My name is Steve and I have with me today Manpreet Gill, our Chief Investment Officer for Africa, the Middle East and Europe, based in Dubai. Now, we've just released our 2024 Outlook, Sailing with the Wind, and today we will cover our views on bonds and currency markets. So thanks, Manpreet, for joining. Let's start with bonds. So is 2024 finally likely to be the year of high quality bonds?
Hi, Steve. Thanks for having me. Yes, we do believe that this may very well be the year for high quality bonds. And we believe high quality bonds, and particularly developed market investment grade government bonds, do fit the attractive risk reward criteria pretty well at this point. Now, the absolute yield, of course, remains attractive, and we still believe we're not that far from recent peaks. And we'd only need modest price gains to beat what's available on cash yields today. Now, the historical context is also important here. History shows us that bond yields usually peak not far from the final Fed rate hike, a point we believe we've likely passed. Longer maturity bonds have also historically outperformed shorter maturity bonds after the previous policy rate cycle peaks. Now, both of these historical examples or pieces of data rather help illustrate why we like high quality bonds, but also why we expect the 10-year US bond yield to fall below 3.5% over the next 6 to 12 months, and indeed why we like longer maturity profiles. Now, what I think is also interesting about high quality bonds is that the risk reward is also attractive under a range of scenarios. So, in our base scenario, the downside in yields or the price gains could be more modest, and we expect the 10-year bond yield, as we mentioned, to fall below 3.5%. However, we also see them as an attractive hedge against our main risk scenario of a harder landing, in which case the fall in yield or rise in prices is likely to be more significant. The last point I'd make, of course, is that the bond view is not just about the top pick of developed market IG government bonds. Smaller allocations towards other major fixed income asset classes can also be quite important to achieving yields that are well in excess of cash, while ensuring that risks remain well diversified. And just as an example, investment grade corporate bonds, where we have a neutral view, also of a fairly high quality nature and offer a yield that's almost on par with cash.
Okay, let's take up on that, because obviously there are even riskier areas, I guess, of bond markets that you can consider, such as high yield or sub-investment grade bonds, as well as emerging market bonds. So what's your view there in terms of, is there a room for that in your portfolio?
Well, we do believe there is some room, but I think the key is to balance that with keeping allocations at sensible levels that's consistent with risk profiles. Now, if we start at high yield as an example, high yield credit usually tends to be more correlated with equities. So it is possible that we enter 2024 on a strong note. However, elevated valuations, still tight financial conditions, and defaults that are now creeping higher do worry us a little bit from a full year perspective. So instead, we'd rather tilt a little bit towards high yield within Asia dollar bonds, which seems to be a pocket where negative sentiment seems to have gone to more of an extreme. And the share of the troubled Chinese real estate sector has fallen sharply after what have been several defaults in 2023. Now, when it comes to emerging market bonds more broadly, local currency bonds arguably look more attractive today relative to EM dollar bonds. Now, local bonds should stay well supported, given central banks in these markets have more room to cut rates in need, and if the dollar does remain range bound and with a slightly bearish bias. EM dollar bonds, in contrast, undoubtedly offer an attractive yield and a high sensitivity to falling US bond yields. But our concern is that we may not have seen the end of credit risks in an environment where US rates are still high. We'd also point out that 2024 also brings a very busy election cycle, which adds up to geopolitical risk across the EM spectrum. So perhaps a bit more patience required on the EM dollar bond asset class before we'd consider adding further.
Okay, I think this is a good opportunity to segue into FX. We know that emerging market assets generally, including bonds, of course, that they're influenced significantly by the US dollar. So obviously we've seen a major development in the past week or so in terms of the Fed changing its guidance on interest rates. So pointing towards interest rate cuts next year. So, what's the outlook for the dollar? Do you expect it to weaken alongside those lower US dollar bond yields?
Well, perhaps in a limited way, but more than that, we think 2024 is really going to be about playing the range in the US dollar. Now, I think when you think about a shorter 3 month horizon, that's where we think the range will be more pronounced, and we're expecting a largely range bound dollar. And on the other side, major currencies pairs, of course, consolidating after what has been more of a market adjustment after the Fed's December meeting. Now, when we look over a longer 6 to 12 month horizon, we do have a bit more of a bearish bias on the dollar. Of course, the Fed's increasingly dovish tone supports our view that G10 central banks have largely ended their rate hiking cycle as global inflation slows. This, of course, in turn is likely to support more range-bound interest rate differentials, which creates an opportunity to play the dollar range, maybe more so with some pairs than others. That's, of course, the baseline scenario. Our main risk scenario is that the US faces a harder landing later in the year, but for FX markets, that arguably translates into risks to yield differentials on the downside, and hence downside risks to the US dollar.
Okay, so I guess what I'm hearing is a modest downside to the dollar, but maybe what are the key opportunities for you for investors in FX in the next 12 months or so?
Well, in terms of opportunities, I think there are three main currencies I'd focus on. First, of course, is the euro, which to some degree benefits from being the default anti-dollar currency in the sort of bearish tilt to the dollar you just described. Now, similar to the dollar, we do see a range-bound euro-dollar in the near term, over the next forecasting 1.1 over the next 3 months, and technicals are a key part of the why we hold that view. But over a longer 6 to 12 month horizon, we do expect the euro to rise modestly to 1.12. Some of that, of course, mirror image of the dollar, but in Europe, growth is currently sluggish, so there may be room for some upside surprise if growth and outlook simply becomes less bad. However, the fact that several ECB rate cuts are already priced by markets for 24 means that upside in the currency is likely to be somewhat limited. Now, a second area to look, of course, is the yen. In Japan, we believe the Bank of Japan is likely to further tighten monetary policy in the first quarter of 2024. So we do expect the dollar yen to continue to move lower as interest rate differentials reduce, as indeed it seems to have already started to do. So we're looking for dollar yen to move towards 139 over the next 3 months and push towards 135 over the next 6 to 12 months. Finally, the last currency we sort of focus on is the Australian dollar, which we expect to see, with some support coming from the terms of trade, which of course the ratio of export to import prices. So we're expecting the Aussie to rise to about 68 cents against the dollar in 3 months' time and about 70 cents in 6 to 12 months' time.
Thanks, Manpreet. That's really helpful. It's been a pleasure as always. And thank you also, listener, for joining us today. That's all we've got time for, unfortunately. You can find a copy of our 2024 Outlook. I think people have heard me say this in the past couple of podcasts as well. So the 2024 Outlook report, Sailing with the Wind, you can find it at the link in the description. Alternatively, you'll be able to find it on our Standard Chartered Wealth Insights pages on either LinkedIn or Facebook. Tomorrow, in our final podcast of the 2024 Outlook mini-series, I will be talking to Audrey Go about how to build an income-focused allocation. In the meantime, thank you so much for listening again, and please take care.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.